Thanks for tuning in to Talking Point. I'm your host, Niraj Shah. Now, obviously, the virus realities come back to bite the markets and in sentiments in some fashion across the world because investors, I think, were attempting once again to shrug off the gloom and doom. But the stimulus measures, which were much anticipated from the US side, are now taking a bit of a step back, or at least momentarily on pause, still awaiting some confirmations out there, and the virus is running amok in the European region as well. So amidst all of this, with none of the two measures which aid the market showing any signs of resolution in the near term, what should investors look forward to in terms of cues, and what should the slightly medium term observation be? Well, Andrew Holland needs no introduction really. He joins us right now on Talking Point today to talk about his thoughts on how is he looking at the current scenario. Andrew, so good having you. Thanks so much for joining in. Hope all is safe.
All good, thank you, and thank you for having me.
No, the pleasure is ours, Andrew. So, Andrew, you look at the world with as much of an eye as you look at India. Before we talk about the high frequency indicators within, can you talk about how do you observe the current scenario as short term an answer as I'm asking you to give?
Yeah, it's a bit tricky in terms of the virus cases are obviously worrying us all in terms of the second wave, particularly across Europe, but even the US has picked up as again more recently. But the market's just living on the basis that the Federal Reserve or central banks will continue to throw money at it. Obviously, governments around the world are still doing fiscal packages. If you look at what's happening in Europe, even though they're doing kind of temporary shutdowns or circuit breakers, as they're calling them, for anywhere that they're kind of closing, then they're putting more money into that kind of that region or area, to keep the economy kind of going. So printing more money is the way they're going. It's interesting, if you look at China's GDP growth for last quarter, which was 4.9% growth. What it's telling you is that once you can get this virus under control, then obviously the rebound can be quite quick. So at the moment, because there's no vaccine and we're into the winter in Europe and the US, then the cases could increase. So I think the market's hoping that we continue to see those packages to keep the economy and keep people kind of spending until a vaccine is kind of implemented, and then we can get back to a normal kind of economy. So that's where we are. So it's in that point of do we have a double dip in terms of a downturn, and whilst on the face of it looks as though you could, because of the government stimuluses, it would just probably keep us bubbling around the same levels for some time.
And just a quick follow-up, because the conversation 3 weeks until the big decision would be incomplete without talking about it. What's your base case? Nobody has a clue whether it'll be Joe Biden or whether it'll be Donald Trump, right? But what's your base case about what impact could it have on markets? Either decision, uncertainty before the decision, and probably the resultant moves after that.
Yeah, so let's say it's a clear win for Biden and the Democrats, then I think that's good for the global economy, because I think, he would naturally be less maybe aggressive towards China in terms of rhetoric and in terms of the trade disputes they're having. So that would give markets again the feel that global growth, including China, could start to pick up. So that would be good news. And obviously, he's talking about huge stimulus in terms of infrastructure spending. So again, that would be good for the global economy, particularly the US. So that's a more kind of positive scenario which the markets are liking. Obviously, there'd be some tax increases at some point, but would he initially bring it in straight away? I think he'd want to fix the economy a little bit more, getting on an even footing before looking to increase taxes. So I think again, that's probably something the market would like. Obviously, we know Donald Trump and we know his policies. So that rhetoric and trade disputes with China, if he was to succeed, would obviously I think had the markets a little wary of that global growth picking up as quickly as we would maybe under a Biden being president. So I think the markets might like Donald Trump because they can see tax cuts and so forth, but it might not be great for global growth in the short term. A contested, messy election, I think, is what no one wants. So I think the market's hoping there's a clear winner, on the day, and we don't have to go to a contested kind of debate and through the courts, which would, again, not be good for global growth and stall, some of the kind of potential for growth in the US in the very short term. And the markets don't like uncertainty, so that would be the thing that we'd want at the moment.
Yeah, and kind of camouflages what would otherwise have been or rather sweeps over what would otherwise have been a very big decibel level election back in India as well, right? Isn't it? But let's talk about India. I was referring to Bihar, of course, but let's talk about India, Andrew. We have seen some effects of what a lot of people attribute as pent-up demand to versus what a lot of people attributed as return to normalcy. How do you read the indicators? Which are the indicators that you're looking at, of course, and how would they impact the markets?
So obviously, you're looking at all the mobility, indicators, which we've been looking around the world, and India is following the same pattern in terms of as we ease out of lockdown, open up different sectors of the economy, open up different industries within the economy. You're starting to see a lot of kind of increases back to kind of pre-COVID levels, which is the good news. So I think we're in festival season now. And the two questions which are asked is this bringing forward sales, or is this a trend that will continue? Now, obviously, I'm putting myself on the line a bit to say that I think there's a different trend, and particularly in maybe car sales and so forth, in that, because of COVID, I think people are saying, I want my own transportation. Maybe there's a fear of public transportation going forward, and maybe because people now, working from home, kind of travel to different areas than they used to do before. So I think that's sustainable. I think that move towards owning your own vehicle, I think is something that will continue after the festival season. In my mind, and obviously some of the government measures, whilst we'll have to see how they play out. I think again, towards the kind of public servants in terms of incentivizing them to kind of spend more money, in over the next 6 months, bodes well, for that to continue. So I think those are the good news factors. So I wait to see what the festival season brings for us, but I am a little bit more optimistic. This is a trend that might not be changing going forward. It might even accelerate as public transport opens up, particularly in Mumbai, for example. And if that brings an increase in levels of COVID, then I think again that would help people kind of move towards I need my own transportation.
So Andrew, actually, tell me. Let's assume. I mean, it's a hypothesis, right? But Q3, which is the current quarter, will have the benefits of the festive season demand because it's one whole month wedged right in between, right? It's not split this time, one whole month here. And probably year-end Christmas, wherein a lot of people would feel that let's go on a holiday because we haven't done it for a while. Q4, we have the RBI already saying that we will turn into the black on the GDP front. Let's assume for a moment that that is actually how it pans out. And then Q1 and Q2 of the next year, we have the benefit of low base of the current year. My question to you is, if indeed the next 4 quarters, we are primed for a favorable print on the growth aspects versus maybe a higher print on the COVID cases, if indeed we open up and the cases multiply, other things remaining constant, do you reckon sentiment will be negatively impacted because of COVID? Or do you think the markets will like the fact that the growth print is looking much better?
Yeah, it's sad in some respects, because I think the markets will like the fact that the growth is there and worry less about the COVID cases. I mean, that's been the case around the world, to be honest. If you've got an environment of low interest rates, growth, coming back, then the hope would be that a vaccine will come through at some point, and that will help people with or reduce the COVID cases ahead. But in between time, if you can live with the fact that COVID's there, and I think as time goes on, we're kind of getting used to it, right? I mean, for my own example, 3-4 months ago, if someone had COVID in the building, you'd be really concerned. And now, if you hear about it now, then it's kind of, okay, what do we need to do? Is there any implications in terms of the building itself? So you're becoming less worried. I'm not saying blasé about it, but you're becoming less worried. Therefore, the markets, I think will just take it of being the fact that at some point a vaccine will come, and therefore, that will only accelerate growth. And let me put it slightly differently to you, in that if a vaccine is found, I just think Asia as a whole will be huge beneficiaries, because we haven't seen that kind of increase in the second wave in particular across Asia. So I see a lot of money flows coming to Asia, particularly China, where you can see growth. Really has been a V-shaped recovery there, and that would only benefit the rest of Asia going forward. And India, obviously, because flows come into emerging markets, would be a beneficiary of that too.
Yes, actually, and there's this interesting chart that you shared with us, isn't it, Andrew? I'll come to the India specific bit, but since you spoke about this liquidity part, the global M2 currency and the Nifty. Now, tell us your reading of this piece, because we've seen liquidity shoot up for sure. What would it mean for the baseline index?
Yeah, so it's a combination of the kind of money in circulation, the accommodative stance. I mean, if you think about it, in India, right? I mean, the government's done around 2% of GDP in terms of packages, which is a lot less than anywhere else in the world. So all the heavy lifting has really been done by the RBI, to my mind. So the great news is if the government listens to the IMF, for example, who is now saying, countries need to spend, and India in particular, don't worry about the fiscal deficit. So it becomes a rating agency thing, if you need to think about it like in that respect. So if you actually have the government also accelerating in terms of their spending, then that's a recipe, I think, for the markets to move a lot higher. But I think in the short to medium term, we're looking towards where the RBI is going to land, and how it's kind of helping across certain sectors. And it's interesting that one of the sectors that they have been focusing quite a lot on is the real estate sector, which has been reeling for many years now. But they seem to kind of be targeting that area as a potential area to kind of get things moving again. And it wouldn't surprise me if real estate, the real estate sector going forward is one of the new themes that you'll emerge out of the virus. Because again, I think people are thinking, not just in India but globally, do I need to live in the center of Mumbai, or can I live in the outskirts now because of work from home? So therefore, the affordable housing kind of market will kind of really kind of accelerate in terms of its sales and growth, and that just brings a different edge to the real estate sector, because it's been one of those sectors as an investment vehicle. We used to think years ago equities, real estate, gold, and so forth. But real estate's been off that list for many years. And if there's a revival there, then you could see more and more investments moving towards real estate, which again has a multiplier effect across the economy.
At Avendus, are you guys doing that, and are you getting money for base real estate investing as well as investing into? I mean, I wonder if the fund strategy is also to invest into real estate stocks. Are both happening parallelly?
So in terms of the funds, obviously there's very limited companies listed, so there's not that many you could look at. But I'm just saying, I think this is a trend more towards how the economy might be moving, and how real estate might be back on the radar as a part of your investment horizon going forward. Let me put it this way. I think if I look at what people around me are doing, there's two things. One, everyone's obviously up into holiday more in and around India, So Alibag is kind of full every weekend. It seems that I can seem to work out from my friends. But people are now looking at can I have a second home somewhere, and would that be in 2 to 3 hours away from Mumbai? So all of these things are starting to play on people's mind, because what we do know is that there's limited things to do in and around Mumbai. I'm not saying the rest of India, but so what do we want to do going forward? It's all about then experiences, right? And I think that's going to come more and more to the fore after we get through this lockdown.
It's also become conducive for people who are not aware. Alibag is a few hours drive from Mumbai, but now with row in row out facilities started,
Yes.
you simply take your car in the boat and reach Alibag in 45. So imagine 3 hours cut down to 45, and that space really gets a bump up. But Andrew, so just before I move on to one more other important aspect, which is India's current account numbers and how would they look, just since we are on the topic of themes, do you reckon that from a listed equities perspective, is it going to be a continuation of information technology slash um, pharma slash specialty chemicals, or do you reckon that now that the economy might be on the mend, some others could come to the fore?
Yeah, it's interesting you mentioned that, because if you go back to 2008, 2009 with the financial crash, I mean, obviously those sectors which perform well are all the defensive sectors, which are pharma, IT, FMCG. But coming out of that in 2009, your best performing sectors were, because the economy is going to start to recover, there's going to be banking, industrials, energy, and consumer discretionary, including autos and all the other things. So, those are the best sectors. So I think having a kind of a barbell approach at the moment, in terms of having some of your defensive sectors, but also having those sectors and companies which benefit from the economic recovery, I think, bodes, kind of gives you that leverage as you kind of move or shift from being defensive towards more kind of economic recovery type stocks, because finding that timing is always very difficult, right? When that shift, when the market's going to make that shift, but it will if what you outlined before in terms of growth for the next 4 quarters, if that was to happen, then that's an economic recovery, and those sectors will continue to do well. The one sector I would say that continues to make me feel still very positive is the pharma sector, because again, if the vaccine comes, then India is going to play a major role in the manufacturing of that, and it puts the India pharma industry back on the global map again, which has been missing for many years. I also think the cost cutting that the sector's been doing over the last few years, will have a big operational gearing impact as the revenue increases. And the tailwinds of better pricing going forward as well, I think helps the generic companies. So I think there's a lot more tailwinds for the pharma sector in terms of growth, rather than just being a defensive sector. So it's the only one sector out of those which I would say I'd probably have some more exposure to, even if the economy is recovering.
I'm surprised you're not saying Indian IT. The managements and everybody who's watching this are saying they can't get enough of it because the commentary seems to be bullish. You're not convinced?
No, I like the IT sector, but I think as the economy recovers, then you'd look at the other sectors in relative terms. I'm just talking about relative rather than I'm not I do like the sector. I think there's a lot of again tailwinds for them. For example, a lot of IT companies in the past would spend a lot of money traveling, say, to Europe, where they'd have to kind of meet with their kind of customers, to give them that comfort that things were working fine and everything was okay in terms of the outsourcing. But I think because of what's happened, and because they can use Zoom or whatever that medium they're using, that comfort level between having physically for people to move around and meet people, I think has gone away. So that will be a huge cost saving again for the IT companies, but also the comfort level of European or US companies being able to kind of do these deals without physically having to kind of come and look at things, and I think is bodes well again for the industry.
Yeah, that's true. Okay, Andrew. Last couple of points, and I I was wondering because there's a conversation that happened with somebody else as well, one fund manager, who seemed to be very optimistic on the CAD numbers over the course of the next 4 or 5 years. The thesis, of course, was that electronics imports will come down to a near trickle zero, thereabouts, maybe some exports as well, and that would be one big component cut out, even if fuel and gold don't go away. What's your sense of uh, what happens to these numbers over the course of the next 4 or 5 years, and how would the markets uh, what would the implications for the equity markets be of a current account surplus, and a big one at that, if indeed that's your thesis for the next few years?
Actually, it's not our thesis for the next few years, because I think
It's not. Okay.
I think you can look at it with both rose tinted glasses or not. On the rose tinted glasses, it's good news in an environment like we have today, that you got a current account surplus. On the other side of it, you're saying, well, really, your imports have really fallen hugely, right? And is that something that is showing the kind of slowdown in the economy as well? So if that was to change overnight, then you'd have to say that India can substitute everything, a lot of what it imports, in the economy, through its own manufacturing, which is clearly not going to be the case. Oil is something that you can't substitute in India. So so it's going to be a gradual process. But the good news is, along with the foreign reserves, is it's given you that stability, for the currency, which is something which I think has been important over this period, because India's in times gone by, when there's been a crisis, then we've always suffered from a depreciating rupee.
Sure. Okay. Andrew, one last question on this conversation, and that is, therefore, if indeed that is the case, and excuse me, I presume that you were saying that the CAD numbers will look better with time, but even if that were not to be the case, or maybe they look relatively better, but not like surplus for good, how do you value what happens? I mean, people look at the absolute number and say that we are back to near highs and therefore we are expensive or we are cheap. When you are looking at the markets and trying to make a decision of whether you want to invest in India or versus you don't want to invest in India and invest elsewhere, what metrics do you look at? Do you look at price to earnings, price to book? Do you look at some other multiples? And therefore, what does that tell you about whether India is an investment case or is not an investment case?
Yeah, so I think you've got to look at a number of factors. I mean, looking at price to earnings, given that there's zero earnings at the moment, is probably not the best way to look at it. And it's also the PE is obviously being skewed by quite a number of the the heavyweights in the index, which are trading on 40, 50 times. So you have to look below that. You always have to look below the kind of headline PE to where the value is, and that's one of the things. So I think price to book is probably a more reasonable way of looking in these kind of times, and therefore we're not overly expensive at this current pace. But I think, to my mind, the what drives market is going to be earnings going forward, and at the moment, whilst we haven't seen any kind of big upgrades, I think if we can get through the next one quarter, and the festive season is good, then I think you'll start to see upgrades coming into the new year, which bodes well, and therefore would bring the PE down. But the driver of the market is not valuations at the moment. The driver of the market is liquidity, and as long as that remains, then markets are going to kind of continue to kind of trying to move higher, work on the basis that 2022 we're going to be back to kind of good growth in India, and there's plenty of reasons to think that long term India is a destination for foreign direct investment as well, which again will have that multiplier effect for the economy.
Okay, Andrew, pleasure talking to you as always. Thanks much for taking the time out, and stay safe.
Thank you. Yeah, thank you. And you.
Thank you. And viewers, thanks for tuning into this edition of The Talking Point.